Hello, everyone. Welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, your host this week after a week off. Thanks to Mark and Adam for filling in for me. Pleased to be joined by Quincy Crosby on location, somewhere on the West Coast. Quincy, where are you this week?
I am up in the area just outside of Seattle, Washington.
Very nice. I bet they didn't get as much rain as we got in Boston over the last month.
Yeah, actually, that's probably true. Yeah.
We have been hammered with rain. I mean, I'm
Yeah.
really sad what happened in the city. You saw that. Boston got less than that, but it has been really wet. So glad we're getting a nice dry day today. We are recording this Monday, October 2nd, 2023. Here is our agenda for today. It's certainly we're going to hit the government shutdown news over the weekend. That's probably the biggest news of the day, other than the rise in yields. That is not new news, but we are up another 10 basis points on the 10-year yield today, up 467 at last check. So we'll recap the market activity from last week, maybe with a comment on September. Then we'll talk about prospects for a Q4 rally. Of course, it's October, so that starts off the historically strong fourth quarter, seasonally anyway. It doesn't happen every year, but it happens most of the time. So we'll assess prospects for that. Next, we will, I didn't set out to make the case that the Fed is done. I just think it's important for people to look at some of the data points out there before you make your own decision. Frankly, we're certainly leaning in that direction. There are points on both sides, no doubt, but we are going to make the case for the most part that the Fed has done its last hike of the cycle. And then when we preview the week, of course, we'll talk about the jobs report. And we also got the ISM manufacturing index today, which is quite interesting. So let's start with the market recap. In September, of course, was down, almost 5%. So a tough month. I guess you could say the week down 0.7% wasn't certainly as bad, but still a down week. And really it was around two issues. I would say, number one, we had the fears of the government shutdown, which the market thought was pretty much unavoidable. But of course, Saturday, McCarthy did an about face, and we actually got a temporary reprieve, pushing that 45 days out. So it's not a solution to the risk of a shutdown. It is just pushing it out. It's kicking the can down the road, so to speak. And we might be in the same position on November 17th. So that was one issue. And then, of course, rising interest rates. And you'll see on the next slide here that bonds were weak as rates rose, and that caused jitters for equity investors. In terms of the sectors, wow, utilities just got crushed. Obviously rate sensitive. That tells you that the market might be more worried about just an inflationary move higher in rates or a treasury supply demand driven increase in rates rather than a recession, right? This is more about growth. And so defensive sectors are not really getting a bid, right? We had, healthcare did okay last week, down 1%, not terrible, but real estate down 1.4%. I mentioned utilities down almost 7% and staples down 2%. So the sector dynamics here are not really pointing to recession or even a pronounced slowdown, at least not based on what we saw last week. So last thing I'll say, and then I'll hand it over to you, Quincy. The international markets were down. The dollar was up over 0.5%. So any observations from you, Quincy, on the equity side for last week or for the month?
Well, yeah, I think from the macro sense, the market's trying to figure out whether or not the higher rates due to more growth, that the market sees more economic growth. After all, the Atlanta Fed now, as of today, for the third quarter, is seeing 4.9% real for the third quarter. But or does it see the rates rising and no growth, because that's the stagflationary side of the equation. One thing about the yields, though, I would add is that I think with the crisis averted scenario, I think you saw selling in the treasuries, pushing the yields higher, because obviously quite a bit of money came in from overseas, from the U.S., in anticipation of a shutdown, which had, the ramifications of which you would not know with the initial closure. So with the crisis averted, I think that what you saw is hitting that 4.7, and then at least coming down to 4.6. And one thing about the market right now, it's interesting because guess who's leading the market higher? Despite the fact that when they're down, all of a sudden what's resurrected is the characterization of big tech as long duration. And then when they're back up, despite the fact that yields are higher, we suddenly drop the long duration rationale for why they're going down. So they've been doing all right. I mean, that's the interesting part of this scenario. But you have oil prices which have climbed higher. They've eased just a little bit. But nonetheless, transports are down today, which I think is an important scenario, given the oil prices and concerns over the economy. So, regarding the Fed, whether or not it's finished or not, I don't think they know whether they're finished. I don't think they do know. I think they are, trying to ascertain whether or not it would be safe to finish, and whether or not there's be a surge of more inflation, and whether stagflation can set in. That's, I think, their major concern.
You're getting a little ahead of our agenda there, Quincy. You just couldn't wait. You wanted to
You asked me that question.
You wanted to add, you want to talk
And
about
I'm out in Seattle. I can say what I want. It's the individual rules out here.
You're on.
Remember that.
Hear what you have to say. We just haven't gotten to our Fed story yet.
Okay.
But certainly it's tied in. It's tied into rates. So here's the fixed income and commodities performance, and you see just negatives across the board, right? With the 1 week returns for bonds all down, and that was the move higher in rates. So I don't really think there's too much more interesting to say about that, other than the fact that you really aren't seeing much widening in credit spreads.
No.
More on that, but that's a good sign too.
Yeah, very good sign. Yeah.
Right. The bond market is saying growth's fine, economy's fine. Maybe a little too strong, but it's not. There's not a negative growth signal coming out of the bond market, certainly. Then turn to commodities. The precious metals have been struggling with the strong dollar and the rise in real interest rates, so inflation adjusted interest rates, and we think that choppiness may continue. So precious metals is not an area we're as interested in now. In fact, we downgraded precious metals on our monthly asset allocation outlook last month to a neutral, and we think the industrial metals look better, and we think energy looks better. So that's that. Well, China's been holding up. We could touch on China at the end if we have time. So here's the S&P 500. I put in Adam Turnquist's more technical look at the S&P, because I thought it would be interesting to look at some of these other dynamics, not just where it is relative to its 200-day. The good news here is the S&P is above its 200-day, so it's in an uptrend, and but also interestingly, it's oversold. So that's the RSI 14 that you see in the bottom two panels here. You have a very you have a high percentage of stocks below 30. That's oversold on the RSI 14, right? I mean, it sounds like a low number. It's 13, but that's historically high. You see these light blue bars. It hasn't gotten really higher than that since the lows in 2022. And then you go back down one more chart to the RSI 14 for the S&P 500. It's at 34. So pretty close to oversold conditions at 30. Not quite that trigger, not a compelling buy signal, but still
Not yet.
right, not yet, but still oversold. We're down a little bit today on the move higher in rates. So this is, setting up for what I would call just a period of consolidation, right? And then 4,200 to 4,300 is still support, but there are levels above that where, we're pretty much at 4,300 now, pretty close. There are levels above that are resistance. So it just paints kind of a neutral, choppy, sideways kind of a picture, which has really been our view for the last few months, frankly. But we'll see if we get that seasonal lift. Let's keep moving and go to the shutdown. So I want your thoughts on this, Quincy, because I'll assume we're going to be in the same position in mid-November, right? We kick the can down the road. It's hard to see a deal. Maybe the McCarthy variable changes the formula a little bit in mid-November. Not sure. We'll see whether he's still speaker. But I guess the question is, what's going to change between now and mid-November that could give investors hope that, we won't have to deal with this? Any ideas?
Yeah, well, just from a granular political level, if Trump maintains his lead, he could come in and just basically tell the seven, that's the caucus, the group that, believe it or not, on the 15th ballot, they're the ones that brought McCarthy into the leadership, into the speakership. But they extracted a number of promises from him, which he has not delivered. So if Trump comes in, and that's something that, it's a possibility, that Trump could either save him or work with the seven and just say, stop it, because it's going to hurt the party. What you saw coming into the weekend were reports that even the Republican senators got involved with the seven and basically made it clear it's about the party right now. It's about the party. So that could be a game change. And the other game change could be that gets McCarthy out, right? And that's the other possibility. And that perhaps then this does continue. But the expectations overall, by the way, are that between now and then, they could actually work on a deal, a more viable deal. Come in with some cuts, do the Ukraine side deal, but be more prepared as they get towards that November deadline.
Yeah, I like that little bit of dose of optimism. Not that I'm rooting for McCarthy to be ousted, but at least it's a path for a bipartisan deal potentially. There or not. And this was bipartisan to kick the can. So maybe you can make an argument that bipartisan, the 45-day extension is an example of, a bipartisan agreement that could maybe lead into some more cooperation down the road. We'll have to see, but boy, it's a tricky one. So we'll keep watching that. Maybe the other piece of good news here is that the stock market tends to shrug these off anyway. Obviously it was down last week, and it was down in September. Seasonality was part of that. The Fed higher for longer message was part of that. The shutdown fear was part too, but it certainly can't be blamed for all of the recent weakness. So I don't think this thesis is broken. If we do get an actual shutdown, we think the market will look past it and probably hold up pretty well. The average, these go back to 1976. This is strategists data. The average S&P 500 performance during a shutdown is flat, and the average 1 month post shutdown is up about 1.4%. So we'll take that if we get it. Certainly, we don't think this is anything to fear if it does happen. So let's move on to prospects for a Q4 rally. And these, we'll bring in some more optimism if the talk of a government shutdown has you down. The fourth quarter on average is up 4% since 1950, over 4% based on the S&P. The batting average is about 80%. So 4 out of 5 years, the fourth quarter is higher. These are excellent odds, much better than the Q3 seasonality that we just came out of. I don't think the presidential cycle changes these numbers dramatically, but I think the fourth quarter average in year 3 of a presidential cycle is a little bit lower. So at any rate, the this seasonal tailwind is powerful, and the question is, are we going to get it this year? Another way to see this is to look at the average progression of the S&P by year. This also goes back to 1950, and you see that we're at a really good spot. We're pretty much at the average low of the back half, right? So this is by trading days, this chart you're looking at. I think we're around 190. So if you have on average, right before the 191st trading day of the year, you tend to bottom and start this nice rally up for Q4. So it doesn't happen at the very start of October. It's like, I think it's like 10 days into October.
Right. Yes.
Right, where you really take off seasonally. But this is certainly good news. So I think the question, Quincy, everybody's asking is this going to play out again? And so we wrote a weekly market commentary this week on this topic. You can find it on LPL.com. And, we make the point that rates is really the key here, right? If rates keep going higher, then it's unlikely we're going to get the stock market higher. The correlations of stocks and yields are as high as they're going to get. And so we got to get yields down. So that's the key. But outside of that, frankly, we think the prospects for this are fairly good because, the economy's holding up fine. Earning season's coming. We think it'll generally be good relative to expectations. And, valuations have adjusted, right?
Yes, they have, certainly.
You're not 22 times, we're at 18. And, if rates come down, I should go back to where I started. If rates come down, probably going to get that fourth quarter rally. Maybe those other factors don't matter. What do you think, Quincy?
Well, look, as long as you can get some very nice returns in the treasury market, money market funds, the market has to work. The market has to work for input. It does. It's been so easy for the market with quantitative easing underpinning the market for so many years now, right? So now the market has to fight for it. And that may be why see the big mega tech, in the green, right? That they're in the green and that the market is down with these higher rates. The market, the view from that, if that continues, is, well, those companies outperform. Those companies have rock solid balance sheets. Those companies have the technology that other companies want, investors want, and if that continues, that would have to be the message from the market. However, the one thing that we're focused on is, are we going to have a repeat of just the generals leading the market higher and not the rest of the market? Now look, at the end of the day, the price action will be the price action, but it's not a healthy market if it's that narrow. And at least, Jeff, as you know, we talked about it so often, the market's performance feeding into the end of the first half actually broadened. We saw the Russell 2000 actually not green for one day. I mean, it actually gained momentum. And that, I think, was a sign that the Russell 2000 saw the economy on solid footing and basically moved beyond the financial crisis in March and started to broaden the overall market. And that's something that we applauded. Now we're back to, wait a minute, is it just going to be the big seven leading the market higher? Now, granted, it's important. What do? They represent nearly 30% of the S&P 500. It's not outlandish to think that that it should be dismissed. You're not going to dismiss it.
Yeah.
So I think that's, yeah, I'm sorry.
Oh, good point. Yeah, the percentage of stocks, I think, over their 200-day moving average is down to like 42. That's a
Yeah,
pretty, but it's somewhere in the
yeah,
40s. That below
yeah,
50, I think when we had that breadth, that participation improvement, right?
right.
More stocks working, we had something in the 70 range.
Yes,
So
exactly, exactly.
yeah, it's a good point. That's a topic maybe we should explore.
Well, yeah,
We have Adam on, the breadth.
this old saying. I mean, I learned this when I, started off um, years ago. Uh, Trade and invest in the market you have, not the one you want. And so, if that's what the market offers us, obviously the market begins to accept it. Is it healthy? Do we give it an A+ in terms of health? No, but nonetheless, it's the market's way. This is the way it continues of saying, look, we don't know what's going to happen. At least we know that these companies perform. They've got the strong balance sheet. Because at the same time, as you and I discussed, Jeff, and we're going to discuss it really soon, is how strong is the economy? Because why are we see recession has come back into play? That's not something we were talking about. We were talking about soft landing for so long. Now it's recession has come back into favor.
Well, based on yields, I mean, the yields are telling a story of stronger growth.
Yeah,
right?
exactly.
Not
Exactly.
recession. So, here you see the 10-year yield chart with these technical lines drawn at 4.7 and 4.9.
Right. Yeah.
We just broke 4.5. I mean, frankly, I'm surprised we're up here, but you could still make the case, and we showed this chart a few weeks ago. If you go back, 100 years plus,
Yes.
it's a pretty normal level, right? It's
It isn't.
the
Yeah.
nominal GDP level. But I think it's a shock to me and many others that we're here because, we were at 0.5% on the 10-year yield, 3 years ago?
It's the speed. It's the speed at which it's cold turkey. It's a cold turkey move.
For the Fed and the 10-year. And so this is just, these numbers psychologically are tough to digest. I think, I would argue that the market's digested these yields fairly well, given we're kind of in that technical range where we thought we would be anyway. And given that tech has still done well, the artificial intelligence enthusiasm is helping, and companies are doing just a terrific job. I mean, there are companies, by the way, that benefit from higher rates that have, more cash, more assets than liabilities, right? So the cash on the balance sheet is working for them. So we shouldn't totally just disregard that piece, but regardless, companies' profitability has really been impressive in the face of higher rates. But if they go much higher, I mean, they're obviously going to affect housing related companies, right? Companies, doing auto loans and things like that. But if that starts to affect just broader consumer spending and broader capital investment, that's when, first, that's when the Fed says, okay, we've done enough, right? But that's also when the market maybe starts to price in a weaker economic environment. So we have some slides coming up here in this next segment that'll, paint the picture of a little bit of economic weakness here. We're not trying to support a bearish call. We're still neutral equities. But I think some of these charts are really interesting to point out, because I think what we have is the market in the bond land, at least saying things are fine or things are good. But then you have some economic data that says, you know what, we're poised to weaken. And, maybe Q4 GDP won't be another 3% number, even if Q3 is. So why might the Fed be done? I guess reason number one, they're getting tighter every day.
Yeah.
I know we've talked about this a number of times here and other channels. The Fed funds rate, if it stays put while inflation falls, then that's a higher real interest rate, a higher real Fed funds rate. And that higher real rate means tighter.
Yeah.
Okay, that gap. So we had the PCE, core PCE come down from 4.2% year over year to 3.9% year over year. The month over month was just a touch better than expected. That is good news. It's still coming down more slowly than we want, but is absolutely moving in the right direction. The Fed has clearly talked the market out of all these aggressive rate cuts in 2024. So you put those things together, they're in a pretty tight spot. So that's first point. I'll run through these quickly, Quincy, and then I'll let you go comment on any of this. The other point, this is from Jeff Roach. The GDP revision from last week was, typically the third revision isn't newsworthy, but it actually was this time. We had services within the consumer spending drop from 2.2% to 1.0. That is a big drop from a second GDP revision to a third GDP revision. So it's not, I'm not trying to be alarmist, but this is a weaker consumer spending environment than maybe we thought. Still, overall GDP was up 2 in Q2. That's fine, and it'll probably be better in Q3, but we're starting off of a lower base. So keep that in mind. Next, credit card delinquencies, 30 days or more, have ticked up a little bit. They're still very, very low historically. In fact, they're even low compared to 2019 pre-pandemic. I looked at the 90-day delinquencies. It's the same story. They're ticking up towards pre-pandemic levels, but they're not there yet. Just want to point out, we know credit card balances are high, I think record highs, and then delinquencies ticking up. So that's something to watch. Here's a chart of mortgage rates. The average mortgage rate, wow, 7.4%. So, it doesn't matter for folks who are on a fixed rate mortgage who aren't moving, but over time, more and more people will move. And if rates stay high longer for the, folks that are moving, this is going to start to hurt. You've already seen it start to affect home builders. Rates were 2.8% in August. Wow. Then the last chart here in this section, then Quincy, I'll let you comment on this. I didn't put spreads in here, but spreads are pretty tight, for investment grade corporate bonds relative to treasuries. And this is really interesting. This shows how many downgrades, credit downgrades S&P did last quarter versus upgrades. And look at the downgrades in red, 210 versus the upgrades in green, only 63. So, and you see it in the bar chart with the reds being the downgrades, far outnumbering the upgrades. And then the up-down ratio, very, very low. That's the light blue line. So the point here is the credit environment is getting tougher. You've probably heard people talk about tighter financial conditions, right? Well, this is more evidence of that. The credit environment is just getting a little bit tougher. So something to point out, doesn't mean necessarily sell stocks here, but it does mean be careful with your high yield, be careful with your credit, because some of these companies that have to term out their debt in the next couple of years are going to have a hard time. So Quincy, your rebuttal to this, what's the other side? What's the other side of the story here? I'm making the case the Fed is done. What's the counterpoint?
Well, just that I don't think they know whether or not they're done. So that's it's not as though they're sitting on their answer and not telling anyone, right? Because I do think they're data dependent. I think they know they acknowledge that inflation remains high. And again, the core is, yes, it came down from 4 to 3.9, which is psychologically good. Nothing better than going from a higher number to a lower number. It didn't go as just a tad. But the question is whether or not they have the patience and the stamina to watch it edge lower without the fear of stagflation starting to creep in. They're very, very much worried about a 70s, the failure of the monetary policy of the 70s. But getting back to this notion about consumer spending, what we saw, the latest data that we saw last week is that personal income rose and personal spending also rose. The month before, we saw personal spending up and personal income down. What we saw last week was that they both rose. Personal income rose, personal spending rose. That's good news. And when all is said and done, what really matters is what we're going to hear on Friday, and that is the labor market, because the correlation, the positive correlation between the labor market and consumer spending is about as tight as you can get. And overall, I mean, you know, we are all been taught, pay attention to the credit market. One thing I do want to say about the credit market is I'm incredibly impressed with high yield. Either high yield is just gone crazy and doesn't know what's going on, or they are sending a signal, hey, stop overreacting. Otherwise, you know, our spreads would be so wide right now. But I think also that the credit agencies, which were slammed because of 2008 and 2009, and we know why, because they didn't do their jobs properly. You remember that? They did not do their jobs properly in 2007, 2006, in those looking at the subprime debt related products. They've been going overboard. They've been going overboard now. Ever since then, they've been very quick to pull the trigger. And you know, you saw Fitch, you saw so you know, I look at that grain of salt. Like suddenly, over the years, they've had to be really out there, making sure everyone knows, oh, we're doing our job, because they spent too many years not doing their jobs. So in any event, I want to see how the labor market performs. And let's remember something, because we talk about the labor market as if it's in a vacuum. It comes from the earnings. It comes from what companies are going to tell us. Because if the companies tell us that their margins are coming under increasing pressure, they're going to have to get to that bottom line by doing something, and that typically involves cost cutting, and that then usually leads to the labor market. So we've been going through the earnings season, and Jeff, as you always point out, the companies have been holding up. Has it been stellar? No, but it's been solid, and we have not seen dramatic pressure on the margins. Once you do, that's why they always say that when the labor market goes, it could go very quickly. The cracks can spread very, very quickly. It's because suddenly companies find themselves under tremendous pressure, and they run around, and the first thing they want to do is start laying people off, because that's where they can bring those margins back and have the margins intact again. So that's why the earnings season is going to be so crucial to the spread from the earnings to the labor market to consumer spending. And I think that's where we're going to have our clues as to where we are headed at the end of the year, and especially in early 2024.
Yeah, absolutely. On the job report, anything in the ones is probably fine, but you know, you don't want a 300 to come out of nowhere and scare the Fed. So that's
yeah, exactly.
Or more.
Consensus right now is 170. That's consensus.
Yes,
right now.
That's why I put the week ahead preview on the screen, so you can see that on the right on Friday, October 6th, and then you know we'll watch average hourly earnings. Hopefully those don't tick up. I mean, some people think that the rise in energy prices is going to seep in to, you know, inflation in other categories and core categories. So hopefully we get a good labor cost number there, and we can, you know, get a little bit of a relief on the energy price side, and we can stop worrying about higher oil prices creating stagflation from the 1970s or anything like that. But there's just no doubt that is the big report of the week, and it can influence yields. We want to see more productivity. We want to see sort of steady. Yeah. We want to see steady job creation, or maybe a little bit slower job creation, and we need wage pressure to come down just a bit. By the way, the ISM this morning, we got a great prices paid. it
Yeah.
dropped from 48.4 to 43.8. That is a big drop. So, it's just manufacturing, which is a small piece of the US economy, but great to see that inflation reading come down. And at the same time, we got a nice uptick in the manufacturing activity index,
Yes.
47.6 to 49. That's good to see. 49 is still below 50. Of course, it's still a contractionary reading, but it's moving in the right direction. So that's good to see. So we got some good data. The bad news, right? It's good news is bad news right now. That certainly contributed to the move higher in yields, along with the, averting the government shutdown. And I'm sure some traders are factoring in more government spending, and you end up, at going from 4.6 to 4.7 on the 10-year in a hurry. So we just need a little more cooling and more months of better inflation data. It's just going to take patience. So I think the ISM services number that I highlighted here is the only other number that really matters.
Oh, yeah.
All that much in all of the data for the week. So we'll of course be watching that. Just, that survey is newer. It doesn't have the history that the manufacturing index has, so it doesn't get as much attention. But services is, what, 65-70% of the economy. It's a much bigger piece than the manufacturing side. So we'll definitely be watching that as we watch yields. So anything else, Quincy, to highlight before we wrap? We covered a lot of ground, I think.
Some of the Fed speak I think we want to pay attention to. Loretta Mester is, I seem to have picked up a cold like in the past 2 minutes. Loretta Mester is on the hawkish side. She's highly regarded. I would call her a pragmatic hawk. And she is speaking and we want to see what she has to say. She did say the last time she spoke publicly that we need to be careful. But we want to see if she's moved over into that camp as well, into the camp that says, why not just pause? Why not be done with it? We'll see if she's gone that far, because that would be a big move if she moves into that realm, into that camp.
Yeah, good point. I think Powell's comments today, even though it really wasn't about, the Fed funds rate or
right,
QT or anything like that, more of an academic presentation, I guess. I think he might have influenced yields a little bit too. So good point. We want to watch Fed speak as well for more hints as to whether they're done or we're going to get one more hike. So good discussion on that. There's certainly a lot of good debates in there in terms of what the Fed's going to do, in terms of whether we're going to get a Q4 rally. So thanks, Quincy, for joining from a Seattle area hotel. I'm glad the audio held up. Thanks everybody for listening to another edition of LPL Market Signals. We will be back with you next week. Everybody have a great week and take care.
Thank you so much.